On February 26, 2022, just 2 days after Russian forces moved into Ukraine, the United States and the European Union took a step that would alter the architecture of global finance. They announced that Russia would be removed from SWIFT, the Society for Worldwide Interbank Financial Telecommunication. SWIFT is the network linking more than 11,000 banks across nearly 200 countries. It routes roughly $5 trillion in daily payment instructions. Cutting Russia out meant its banks could no longer send or receive international transfers, no settlement channels, no trade financing, no cross-border clearance, a forced economic blackout. Washington and Brussels hailed it as the ultimate sanction, the financial equivalent of a nuclear strike. The assumption was simple. Russia's economy would collapse under isolation. The assumption was simple. The ruble would crash, the economy would spiral, and Putin would either retreat or face unrest at home. But 2.5 years later, the outcome was nothing like what Western policymakers expected. Russia didn't implode, the ruble rebounded, trade flows continued, just outside of SWIFT. Moscow found workarounds. And the real shock wasn't Russia's resilience. It was the reaction from the rest of the world. Dozens of nations watched the sanctions play out and immediately began developing their own escape routes. Because if Washington could sever Russia from the financial grid for political reasons, it meant it could sever anyone. This wasn't an isolated episode. Major powers have weaponized financial infrastructure 4 times over the past century, and every single time the sequence is identical. A dominant state controls the financial system, turns it into a tool of coercion, the targets build substitutes, neutral nations diversify, and the original weapon loses its strength. The dominant power believes it's exercising unmatched leverage, but in reality, it's undermining the foundations of its own supremacy. So here are the 4 historical precedents, the 5-stage cycle that repeats without fail, the hard data showing the same process unfolding with SWIFT and the dollar today, and why China is positioned to benefit more than anyone else. The timeline suggests the U.S. has roughly 20 years before the dollar's reserve dominance erodes. Britain weaponized its financial system in 1914 and lost reserve currency status by 1944. 30 years. The U.S. weaponized SWIFT in 2022. The countdown has started, and this time the shift will move faster, because rival systems already exist and technology accelerates adoption. But before we get into how the SWIFT strike backfired, you need to understand what SWIFT actually is and why it matters. SWIFT isn't a bank. It doesn't store money. It doesn't move funds. It's a messaging network. When a bank in New York needs to send $1 million to a bank in Tokyo, SWIFT transmits the secure instruction. The cash itself moves through correspondent banks, but SWIFT is the communications spine that makes the transfer possible. SWIFT was founded in 1973 by 239 banks across 15 countries. Before that, payments relied on telex, slow, error-prone, insecure. SWIFT standardized formats, built security layers, and made cross-border settlement efficient. By 1977, it handled 10 million messages per year. By 2024, over 11 billion, roughly 45 million each day. SWIFT became the nervous system of global finance. And here's the key. Though it's headquartered in Belgium and formally neutral, its governance is dominated by American and European institutions. And because most international transactions clear in dollars through New York, Washington has legal leverage, which means the U.S. can push SWIFT to expel banks or entire nations. If you're removed from SWIFT, global trade becomes nearly impossible. You're financially isolated. And Washington has used this tool before. In 2012, the U.S. pressured SWIFT to cut off Iranian banks. The result was catastrophic for Iran. Oil revenues collapsed because buyers couldn't remit payments. GDP contracted. Inflation exploded. Tehran was forced into negotiations, culminating in the 2015 nuclear agreement. The weapon seemed effective. But Iran spent those years building workarounds, alternative payment routes, barter systems, crypto channels, and non-dollar trade with China, Russia, and Turkey. When sanctions snapped back in 2018, Iran endured far better because it had already reduced its dependence on SWIFT. But the 2022 cutoff was a different magnitude entirely. This wasn't a mid-sized economy like Iran. This was the world's 11th largest nation, a top energy supplier, a nuclear state, and a permanent member of the UN Security Council. Removing Russia from SWIFT wasn't just economic pressure. It was a declaration that the U.S.-led financial system could banish any nation for political reasons, and every government watching absorbed the message. Cross the United States, and you can lose access to the global financial network. Your reserves can be frozen, your banks isolated, your economy choked. That created an existential choice for every non-Western state: accept permanent exposure to U.S. financial power or build escape routes. Most chose to build escape routes, and that's when the swift strike began to backfire. Because financial weaponization has a century-long history of turning against the user. The pattern has repeated 4 times. Each time the dominant power was convinced it held unparalleled leverage. Each time the act sped up its decline. Example 1. Britain in World War I from 1914 to 1918. Before the war, the pound was the world's reserve currency. London was the center of global finance. Britain controlled roughly 65% of international reserves. When war broke out in August 1914, Britain passed the Trading with the Enemy Act, giving itself authority to freeze German assets. London seized German-owned companies, accounts, ships, and property across the empire. This was unprecedented. Finance had always been insulated from conflict. Nations fought wars on battlefields but respected financial agreements. Britain shattered that separation. The immediate impact on Germany was crippling. German firms lost assets throughout the world. German banks were shut out of London. German trade collapsed. Britain believed this delivered strategic advantage. But neutral countries saw something far more dangerous. If Britain could confiscate German assets, it could confiscate anyone's assets in any dispute Britain defined as important. Your wealth in London was only safe if London approved of your politics. After the war, neutral nations diversified reserves away from Britain. Gold holdings rose. New accounts were opened in New York, Paris, and other emerging financial hubs. The United States gained massively. Capital that once flowed through London shifted to New York. By 1920, the U.S. held more gold than Britain. By 1925, New York rivaled London as a global financial center. And by the 1944 Bretton Woods Agreement, the dollar officially replaced the pound as the world's reserve currency. Britain's weaponization of finance in 1914 ignited a 30-year descent from dominance to irrelevance. The pattern is clear. Britain controlled the system. Britain weaponized it. Targets and neutral nations diversified away. Britain lost the system. Britain lost control. Example 2, the United States and Iran, 1979. When Iranian revolutionaries seized American hostages in November 1979, President Carter responded by freezing every Iranian asset inside the United States, roughly $12 billion, $8 billion in bank deposits, $4 billion in additional holdings. At the time, it was the largest asset freeze in history. The legal justification was straightforward. Iran had violated international norms by detaining diplomats, and the U.S. was exerting pressure to force their release. But the consequences reached far beyond Iran. Around the world, especially across the Middle East and OPEC, governments suddenly realized a dangerous truth. Dollar reserves held in New York could be frozen without war, without negotiation, without due process. No invasion required, no court ruling needed. A single presidential order could immobilize a nation's wealth. Sovereign reserves weren't sovereign if they lived inside the U.S. banking system. Throughout the 1980s, OPEC states began quietly diversifying. Dollar holdings dropped from about 85% in 1977 to 71% by 1991. Gold reserves increased. Holdings of Deutsche Marks and yen expanded. Saudi Arabia, Kuwait, and the UAE reduced U.S. Treasury exposure. Banks in London, Zurich, and Singapore received deposits once destined for New York. The dollar's share of global reserves began a slow erosion that continues to this day. The Iranian freeze succeeded tactically. The hostages were released in January 1981, due in part to economic pressure. But strategically, the move broadcast a clear message to the world. Dollar reserves were vulnerable to political decisions in Washington. The U.S. gained leverage over Iran but sacrificed trust everywhere else. Example 3, the United States and Russia, 2014. After Crimea came under Russian control in 2014, the U.S. imposed targeted financial sanctions. Russian officials were barred from the American system and major banks faced restrictions. But Washington stopped short of the ultimate step. Russia was not removed from SWIFT. The sanctions signaled displeasure, but they didn't sever Russia from global finance. This hesitation was a strategic error because it handed Russia 8 years to prepare. From 2014 to 2022, Russia systematically dismantled its exposure to the dollar. U.S. Treasury holdings fell from $130 billion in 2013 to just $2 billion by 2020. Gold reserves doubled from 1,000 tons to over 2,300. Russia built SPFS, a domestic messaging system designed as a SWIFT substitute. Simultaneously, Moscow negotiated trade arrangements with China, India, and others, enabling settlement in yuan, rubles, and rupees instead of dollars. A full alternative trading architecture emerged, and Russian leadership openly explained why. The U.S. had demonstrated that dollar reserves could be turned into political weapons. That made the dollar unsafe. Western analysts dismissed this as rhetoric. They insisted Russia was too integrated into global markets to meaningfully reduce dollar dependence. They were wrong. When the 2022 sanctions arrived, Russia was prepared. The 2014 measures achieved limited economic pressure, growth slowed, investment fell. But they also provided time, motivation, and clarity. Had the U.S. imposed either no sanctions or a full SWIFT cutoff in 2014, the geopolitical landscape would have evolved very differently. Instead, Washington chose the worst possible option, a calibrated strike that warned Russia without crippling it, giving Moscow 8 uninterrupted years to build escape routes. Example 4. The United States and Russia, 2022. This was the breaking point. On February 26, 2022, the U.S. and EU activated the one measure Western officials had always described as unthinkable. Major Russian banks were ejected from SWIFT. And alongside that, $300 billion of Russia's central bank reserves held in Western financial institutions were frozen overnight. This was the financial equivalent of a nuclear strike, an attempt to paralyze an entire sovereign economy by cutting it off from the bloodstream of global finance. At first it looked as though it worked. The ruble sank 30% in 48 hours. ATMs across Russia ran dry as people rushed to withdraw cash. The Moscow exchange shut down to prevent a complete market collapse. Western commentators declared mission accomplished. Russia, they said, would crumble within months. But then the expected collapse didn't happen. The Russian central bank responded with shock therapy. Interest rates were raised to 20% in a single move, instantly stabilizing the currency. The government then issued a demand Europe couldn't ignore. Gas payments had to be made in rubles. That artificial demand forced the currency higher. Within 3 months, the ruble had regained everything it lost and climbed past pre-sanction levels. Trade rerouted instead of disappearing. Oil and gas went to China, India, and the Middle East. Settlements moved into yuan, rupees, and rubles. By late 2022, the Russian economy had stabilized. By 2023, Russia's GDP growth outpaced Germany and the UK. But the real damage wasn't to Russia. It was to the dollar and to SWIFT, because every major non-Western country drew the same conclusion. If the United States is willing to freeze a nuclear power's reserves and cut it off from the global payment network for political reasons, then no one is safe. Not China, not India, not Saudi Arabia, not Brazil. They all ask the same question. We're not in conflict with the U.S. today. But what about tomorrow? Taiwan, Kashmir, oil policy, trade disputes? Could the U.S. freeze our reserves, cut us off from SWIFT? The answer was obvious. Yes, the precedent existed now. And once that precedent exists, every rational state prepares for it. So they did what Britain's rivals did in 1914 and what OPEC states did in the 1980s. They diversified out of the dollar, out of Western banking channels, and away from SWIFT. This is when the 5-stage backfire pattern began, the same pattern that has repeated 4 times in the last century. Stage 1. The dominant power controls the payment system. From the 1970s through 2022, the U.S. effectively controlled SWIFT, not by owning it, but because most SWIFT messages ultimately interacted with dollar clearing in New York. Treasury sanctions and Federal Reserve oversight meant the U.S. could block any bank it chose. SWIFT relied on dollar infrastructure, and the dollar relied on U.S. military and economic primacy. That synergy created unmatched financial dominance. Stage 2. The dominant power weaponizes the system. After 9/11, the U.S. used financial sanctions aggressively, first against terrorist networks, then against Iran and North Korea, then against Russia in 2014. Every round normalized financial warfare. turning the dollar from a neutral reserve currency into an instrument of geopolitical punishment. By 2022, using SWIFT against Russia seemed natural. Infrastructure existed, precedent existed, political momentum existed. So Washington pulled the trigger, cut Russia out, freeze its reserves. Stage 3. The targets build alternatives. Russia lost access to SWIFT, so it switched to substitutes. SPFS, its domestic messaging system, expanded rapidly. CIPS, China's cross-border payment system, became the backbone for Russian trade. Transactions shifted to yuan, rubles, rupees, and dirhams. Cryptocurrency and barter deals filled smaller gaps. By 2024, nearly 40% of Russian trade occurred outside the dollar-euro system entirely. Russia became the proof of concept that a major nation can survive, even adapt, outside the Western-controlled financial architecture. Russia's SPFS system scaled quickly. China's CIPS network, the cross-border backbone of yuan settlements, became the primary channel for Russian international payments. Smaller gaps were filled by cryptocurrency transfers and barter arrangements. By 2024, nearly 40% of Russia's total trade was denominated in non-dollar currencies. Russia-China trade surged to $240 billion, almost entirely in yuan and rubles. Russia-India trade settled largely in rupees. Russia-UAE trade increasingly used dirhams. Russia proved a point no one in Washington expected. A major power can be cut off from SWIFT and the dollar network, and keep going. Stage 4. Neutral countries hedge. This is the turning point. It's not about Russia anymore. It's about the dozens of countries that aren't sanctioned but suddenly realize they could be. They watched a G20 economy lose access to its reserves with a single announcement, and they understood the risk instantly. China moved first. It accelerated de-dollarization at full speed. U.S. Treasury holdings fell from $1.3 trillion in 2013 to $775 billion in 2024. Gold reserves were increased massively, officially 2,264 tons, but in reality very likely over 4,000. CIPS volume expanded from roughly $300 billion in 2021 to more than $500 billion by 2024. Then came Saudi Arabia, a U.S. ally for 8 decades. After watching Russia's reserves frozen, Riyadh reassessed its entire strategy. In March 2023, it announced it would accept yuan for oil sales to China, breaking the 50-year petrodollar exclusivity. In December 2024, Saudi Arabia joined BRICS, a geopolitical earthquake signaling a shift away from guaranteed U.S. alignment. The UAE followed the same path, clearing trade with India in rupees and dirhams, bypassing dollars. Brazil and Argentina negotiated a shared settlement currency for bilateral trade. BRICS itself expanded to 9 states, Saudi Arabia, UAE, Iran, Egypt, Ethiopia, and began developing a cross-border payment network with the ambition of a commodity-backed common currency. Even U.S. allies started hedging. The EU built Instex, originally for trade with Iran, now a model for broader non-dollar settlements. Japan and South Korea quietly increased yuan reserves. More than 50 central banks began testing or implementing alternatives to SWIFT. Not because they oppose America, but because they watched $300 billion of Russian reserves vanish at the stroke of a pen. They realized their assets were safe only as long as Washington approved of their policies. Stage 5, the original weapon begins to lose power. This is the phase we're living through right now. SWIFT is still dominant, but shrinking. The dollar's share of global reserves has fallen from 71% in 1999 to 58% in 2024, a 13-point drop that represents trillions moving elsewhere. More telling is trade settlement, from 73% in 2022 to about 58% by 2024, a 15-point collapse in 2 years, the fastest de-dollarization on record. SWIFT's total message count is still rising, but its global share isn't. CIPS processed 136 million messages in 2023, up from 91 million in 2022, a 50% increase in a single year. SPFS now handles around 2 million domestic messages per day inside Russia. India's Unified Payments Interface processed 12 billion transactions in 2024, including a rapidly expanding cross-border segment. The pattern has repeated itself exactly. Once financial power is weaponized, alternatives grow, neutral states hedge, and the original system begins to erode. Alternative systems are scaling fast. And here's the core insight. The swift strike worked tactically. Russia took a hit. But strategically, it failed. Russia absorbed the shock. And the swift weapon can't be used again with the same force because every future target is now preparing in advance. Neutral countries built insulation. The vulnerability is gone. The pattern repeats. Stage 1, control the system. Stage 2, weaponize it. Stage 3, targets build alternatives. Stage 4, neutral states hedge. Stage 5, the weapon loses power. Britain followed this arc from 1914 to 1944. The United States is following it from 2022 to 2042. Now here's the hard data showing it's happening right now. These aren't forecasts. These are measurable shifts. Russian trade. In 2021, before sanctions, 87% of Russia's trade settled in dollars or euros. By 2024, that number dropped to 60%. 40% is now yuan, rubles, rupees, dirhams, and other currencies. Russia-China trade reached $240 billion, almost fully in yuan and rubles. Russia-India trade reached $65 billion in rupees. Russia is the proof that a major economy can operate outside the dollar SWIFT system, China's CIPS network. In 2020, it processed around $12 trillion in payments. By 2023, $27 trillion, more than double in 3 years. CIPS now connects over 1,400 institutions in 110 countries. It settles in yuan. It's a direct competitor to dollar SWIFT, and it's growing faster. Central banks are buying gold at record levels. In 2022, 1,136 tons. In 2023, 1,037 tons. In 2024, over 1,000 tons again. 3 straight years above 1,000 tons. The heaviest sustained buying since the 1970s, right before Bretton Woods collapsed. Who's buying? China, Russia, Turkey, India, Poland, Singapore, Czech Republic. They're converting dollar reserves into gold because gold can't be frozen. Bilateral currency swaps. China now has swap lines with more than 40 countries worth roughly $500 billion. These give nations the ability to settle trade in local currencies without touching the dollar. Russia has swaps with China, India, and Iran. India has swaps with UAE, Japan, and others. Brazil and Argentina are working toward a shared settlement currency. ASEAN states are discussing regional trade in local currencies. All of this bypasses the dollar. Petrodollar erosion. For 50 years, oil was sold almost exclusively in dollars. That enforced structural dollar demand. But in 2023-2024, the monopoly cracked. Saudi Arabia accepts yuan from China. Russia sells oil to India in rupees. The UAE accepts dirhams and yuan. Iran sells to China in yuan. Iraq is negotiating yuan pricing. The petrodollar isn't gone, but it's no longer exclusive. And once exclusivity breaks, dominance unravels quickly. BRICS. Expansion and currency plans. BRICS grew from 5 members to 9. Together, they represent 45% of global population, 36% of global GDP, and 42% of global oil output. At the 2023 Johannesburg Summit, they announced work on a BRICS settlement currency backed by commodities, gold, oil, rare earths. Not launched yet, but the direction is unmistakable. They're building a structural alternative to the dollar system. The data is overwhelming. De-dollarization isn't a theory, it's an ongoing process, and accelerating. It's happening now, and it's accelerating. Every month, the dollar's reserve share slips. Every quarter, CIPS volume climbs. Every year, more trade settles in local currencies. The swift strike didn't just punish Russia, it broke the dollar's monopoly. Now here's the timeline. How long does the US have before the dollar loses reserve status? We can estimate by looking at Britain's fall. In 1914, Britain weaponized finance by seizing German assets. In 1944, at Bretton Woods, the dollar replaced the pound, 30 years from weaponization to replacement. But Britain also fought 2 world wars that gutted its economy. Financial weaponization alone didn't end the pound. It was weaponization stacked on war and mismanagement. The U.S. isn't fighting world wars. Its economy is still the world's largest, so the decline might be slower. But technology speeds everything up. In 1914, building alternative systems took decades. In 2024, CIPS scaled from $12 trillion to $27 trillion in 3 years. Digital networks grow exponentially. The decline could be faster. Based on historical patterns and current acceleration, the window is 15 to 25 years from 2022. That puts the dollar's loss of dominance somewhere between 2037 and 2047. Not erased, but no longer hegemonic. Dollar reserves fall from 58% today to roughly 35 to 40% by 2040. Still important, but not dominant. The euro might take 25%, the yen 20%, gold and others 15 to 20%. A multipolar currency world. The path is already set. The dollar lost 13 points between 1999 and 2024, 25 years. At that pace, another 13 points lands at 45% by 2049. But the pace is quickening. The last 2 years alone saw a 4-point drop. If that trend accelerates, 45% arrives by 2035. The timeline is 10 to 25 years. Not centuries, not generations, 1 or 2 decades. And here's what that means. Right now, the U.S. runs massive deficits because the world needs dollars for trade and reserves. Foreign buyers purchase treasuries to obtain dollars. That lets the U.S. borrow $2 trillion a year at low rates. Dollar dominance exports inflation abroad. But once the reserve share drops below 40%, that benefit disappears. Foreign demand for treasuries collapses. U.S. interest rates spike. Deficits become unmanageable. Washington must balance its budget or face inflation. The American lifestyle, importing more than it exports and paying with printed dollars, becomes impossible. The free lunch ends. Now, who wins? China wins by far. It's the natural successor to U.S. financial power. It has the second largest economy, the biggest manufacturing base, the largest global trade footprint, and a rising reserve currency. CIPS is China's SWIFT. The yuan is gaining reserve status. China holds massive gold reserves. Chinese tech giants, Alibaba, Tencent, now run payment networks that rival Western systems. As the dollar weakens, the yuan strengthens. China doesn't need to defeat the U.S. militarily. It only needs to let the dollar buckle under its own contradictions, amplified by America's use of financial warfare. Russia also wins strategically. Its economy is smaller than China's, but it proved a critical point. A major nation can survive a swift cutoff. That demonstration changed everything. Any country that once feared U.S. financial power now knows alternatives exist. Russia's survival shattered the idea of American financial omnipotence. And Russia tightened ties with China, India, Iran, and others. It isn't isolated. It's at the center of an emerging alternative bloc. BRICS nations benefit as well. Brazil, India, South Africa, plus new members Saudi Arabia, UAE, Iran, Egypt, Ethiopia, all gain leverage in a multipolar currency world. They can balance U.S., Chinese, and European interests. They're no longer trapped in dollar dependence. India is the clearest case. It kept relations with Russia despite U.S. pressure, bought discounted oil, settled in rupees, and faced no punishment. This is the future for middle powers: more autonomy, less U.S. dominance. Gold wins. When trust in fiat currencies erodes, central banks buy gold. Purchases are at 50-year highs. Alternative payment systems win. CIPS, SPFS, India's UPI, Brazil's PIX, crypto exchanges, any system enabling non-dollar, non-SWIFT transactions gains market share. Fintech firms across China, India, Russia, and beyond expand as countries diversify away from Western rails. Now, who loses? The United States loses hegemony. Not instantly, not through collapse, but through steady, irreversible erosion. Dollar reserve status is the core of U.S. power. It enables limitless deficit spending, effective sanctions, and an inflated standard of living. As dollar dominance fades, these advantages vanish. Washington must balance its budget. The U.S. military becomes expensive without endless borrowing. American living standards slip relative to the rest of the world. America doesn't become poor, it becomes normal, large, wealthy, but not a hyperpower. Europe loses alongside the U.S. European nations tied themselves to the dollar system. They joined sanctions, froze Russian reserves, supported the SWIFT cutoff. That alignment bound Europe to the dollar's decline. The euro could have risen as a counterweight, but Europe didn't pursue that path. It followed U.S. leadership. So as the dollar falls, the euro doesn't rise. The yuan does. Europe becomes economically subordinate to both the U.S. and China. SWIFT loses relevance. It's Belgian on paper, but viewed globally as a Western tool. As countries diversify away, SWIFT usage drops. It won't vanish, but it becomes one network among several, not the dominant one. Its revenue depends on volume. And as payments shift to CIPS, SPFS, and regional systems, SWIFT's model weakens. Dollar holders lose wealth. Anyone holding treasury bonds or dollar deposits faces slow erosion, not hyperinflation, but steady 5 to 10% annual loss of purchasing power as the dollar weakens relative to stronger currencies and gold. A treasury yielding 4% while losing 7% to inflation and devaluation is a guaranteed negative real return. Investors move into other assets. That shift accelerates the dollar's decline. American consumers lose purchasing power. The U.S. imports far more than it exports. The trade deficit runs around $800 billion a year. That's only sustainable because foreign buyers still accept dollars. When they don't, the U.S. must export more or import less. That means fewer goods, higher prices, and falling living standards. The average American household, used to cheap Chinese products, cheap foreign oil, cheap imports across the board, will see costs climb 20 to 30% over a decade as the dollar loses reserve status. The timeline is locked in. The SWIFT strike in 2022 triggered the 5-stage backfire cycle. We're in stage 4, neutral nations hedging. Stage 5, the erosion of the weapon itself, is already starting. By 2030, dollar reserves likely drop to 50%. By 2040, closer to 40%. The U.S. will still hold the largest single share, but not dominance. This is a multipolar currency world, and America emerges weaker. Here's the bottom line. In February 2022, the SWIFT cutoff and reserve freeze looked like overwhelming force. But financial weapons resemble nuclear weapons. You can use them once. After that, everyone prepares defenses. Russia built its own channels. China accelerated CIPS. BRICS expanded. The petrodollar fracture began. Now the SWIFT weapon is nearly powerless. Any country the U.S. might target has already built alternatives or is building them now. America could have preserved dollar leadership through economic strength, open trade, and stable rules. Instead, it chose financial coercion, freezing assets, cutting off SWIFT, turning the dollar into a pressure tool. That approach worked tactically against smaller states like Iran. Against Russia, it backfired, and the backfire is structural. It's not just Russia exiting the dollar system. It's half the planet. Britain weaponized finance in 1914 and lost reserve status by 1944. The U.S. weaponized SWIFT in 2022. The pattern points to American dollar dominance fading by 2042, maybe sooner, because technology speeds everything up. This isn't prophecy, it's pattern recognition. Financial weapons always backfire. The dominant power believes it's demonstrating ultimate control. In reality, it's teaching the world to create alternatives. And once alternatives exist, the original system loses its grip. The SWIFT weapon broke SWIFT's monopoly. The dollar weapon is breaking dollar hegemony. And the country that gains most is China, the patient rival that watched the U.S. dismantle its own advantages. China didn't defeat America militarily. It didn't need to. The U.S. undermined itself by weaponizing the very system that made it dominant. The 5-stage pattern is finished. The U.S. controlled SWIFT and the dollar. The U.S. weaponized both against Russia. Russia built alternatives. More than 50 nations are now hedging, and the weapon is losing power. This is the end of dollar hegemony, not with an explosion, but with quiet self-inflicted damage, not through battlefield defeat, but through financial suicide. The SWIFT weapon worked once. It won't work again. Because the world learned the rule: build alternatives, diversify away from dollars, never rely on U.S. financial goodwill. If this documentary revealed a pattern you hadn't seen, if you understand now that financial weapons always backfire, if you recognize that the SWIFT cutoff marked the beginning of dollar decline, not its peak, then you understand the next 20 years of geopolitics. The dollar will fall. The yuan will rise. The world will be multipolar, and the US will be weaker, not because China attacked, but because America chose policies that eroded its own foundation. It had the golden goose, and it strangled it with sanctions. Welcome to the post-dollar world. It's not fully here yet, but it's approaching. The timeline is set. The pattern is unambiguous. The SWIFT strike was the trigger. And 20 years from now, historians will look back at February 2022 and say, that was the moment U.S. financial dominance ended. The only people who didn't recognize it were the ones living through it.